Welcome to another episode with Loans Elevated. My name is Broch TJ, top 1% loan officer nationwide.
And I'm TJ Heidenreich. Together we bring the latest news, strategies, and insights in the mortgage and real estate industry.
Okay, TJ, so what are we talking about today?
Well, I don't know. I was falling off you, so you can't start it off like that.
I know, that's right. Okay, so today we are going to dive into something that we personally feel is a really big issue with the state of the economy and how that impacts the behavior of mortgage people like us. We strive so desperately hard to provide something that is a real value to our clients, a neutral source of advice and strategies and insights, almost not even paying attention to if this means we are going to make money or not. We give legitimate advice. The beauty is I've been doing this for 15 years. I have a very long-standing, stable career in this business. TJ, you've been in it for how long now?
4 years.
4 years. Mm-hmm. And I've been talking to TJ. A lot of people probably don't know this. I've been talking to TJ about getting this business since he was 10 or 11 or 12. Something like that. So we'll just call it that he's also had the career for 15 years. He's just only been being paid for the career for 4.
There you go.
But that's significant because as the economy evolves into more desperate times, people in our industry, the fact is our industry has a very, very low barrier to entry, which means you can get a job as a loan officer pretty easy. You got to go take a few hours of licensing. You got to pass a test, which is relatively easy in my opinion. And then you got to go get a company to hire you. And voila, you're a loan officer. You can sell the program, same programs we can sell. However, when you don't have a stable career and a long-standing reputation with relationships within the industry, like realtors, builders, and a database to rely on, and just the reputation that people know you do the right thing, it's very hard, especially today, with rates increasing, unstable economic conditions, unstable house prices. It's very hard to encourage people to actually move forward and buy houses. That causes our competitors to become extremely
desperate.
Yeah, extremely desperate. And they suddenly, it's hard for us. We're making way less money. The business, we're working twice as hard for a third of the money. It's a challenging time, but we don't ever question, can we feed our families? Can we, pay the mortgage? Can we live our lives? That's never in question because of the stability and tenure of our careers and the reputation we built. Many of our competitors do worry about that. And when they worry about, can I pay the mortgage and put a roof over my family's head, or can I put food on my family's table? Well, suddenly the client or your end result or the financial result of what they guide you to do maybe isn't front and center. That may not be the most important thing. So I just wanted to lay that out there. We don't have anybody in particular that we are saying is doing this, and we're really not talking smack. There's a lot of respectable people in this industry. We're not the only ones with long-standing careers, great reputations. There's dozens, probably hundreds right here in our marketplace. So not everybody is bad, but the fact is there's north of 200,000 lenders nationwide. There's a very big portion of them that don't take it seriously. They think it's easy money. And they lose sight of the client being the main, your financial security being the main objective, and start focusing on, am I going to get a paycheck, especially in a market like now?
Right. Well, they're starting to cut corners too in their processes because the times are tough right now. Like we talked to a competitor that they're not even doing a credit pull until the client is submitting offers on a home, which could be detrimental.
Oh, 100%. Yeah, no credit pulls. So these are cost-cutting measures to accomplish the same thing. Mm-hmm. But we're also seeing massive, massive layoffs in the industry. What does that mean? Well, they're not as effective. They're not as communicative. They aren't paying as much attention to make sure that you get the best deal. They lock your rate on time. They float your rate down if the market improves. And a lot of these opportunities, with how volatile the market's been, it requires more bandwidth today than it did when rates were super low and the business was booming. It actually requires more bandwidth to get loans done today.
Oh,
and
100%.
And more, like you said, if they are lazy in the pre-approval to save a few bucks on a credit report, they're putting clients at risk. I mean,
for thousands of dollars.
Yeah, and maybe it's not financial risk because now clients can, negotiate
Yeah, I guess
timelines
that's
and not
true.
have their
Yeah,
hard earnest
right.
money. It could be. I guess I don't know.
Right.
But even just the emotional
roller coaster, yeah.
It's like you go see the house, you like it, you take the kids there. The kids pick out their rooms and they're dreaming about this house. The family's dreaming about barbecuing. And then suddenly, because of a lack of diligence in the pre-approval,
wasted their time, which is and way more valuable than money in some cases.
100%. And if it works out really bad, it's like, oh man, well, because of this one thing that we didn't do our proper due diligence up front to save a few bucks, now your budget is not $600,000, it's $400,000.
Right.
Now, can you even go? You're already sold on the $600K budget. It's like it seems seemingly impossible to go and mentally buy into a $400,000 house.
Right.
After you've done it.
Right. Well, let's also dive into this because I know you're super passionate about this. I've come across competitors when I see their quote. My clients say that this is their starter home, and I see a quote come across, and the other lender is charging them 2 and 3 points for this. I mean, and their break-even point is sometimes 5 to 7 years down the road. 100%. I mean, dive into that, what that actually means.
So from my perspective, and you fill in the blanks here, from my perspective, that goes to people, the low barrier to entry. These are people that they see a program, they see a rate sheet, they see the ability to buy down. These are all very basic concepts in our industry. What they're not seeing is what does today's decision and the money we're spending today, how does that impact things 6 months, 12 months down the road? And they don't even understand what's going on in the market in many cases. We spend countless hours. I mean, it's like, it really is my passion, tracking the market, understanding what's going on, being as strategic as possible, because this is not only one of the largest, if not the largest investment families ever make, but it's also, there is so much money attached to every decision. And it might on the surface look like you're saving money because you're buying the rate down, your payment's marginally lower, but you're ignoring the fact that you're dumping 10, 12 grand to save a few $100 a month. And if you're paying attention to the market, the signs we see is that you're probably not going to have that loan for sure no longer than 24 months. Well, the break-even point is longer than 24 months in every case that I have seen lately.
Yeah, same here.
And so this is really what I view is this is a challenging business. There's a lot of emotions, there's a lot of money, and clients know they need to shop for the best deal. So a lot of competitors are afraid to talk about the elephant in the room, which is rates are miserable. They suck. There's no way around it. Every lender's going to have about the same rates. However, they'll say they have a lower rate, but attached to that lower rate is massive discount fees, which on the surface, again, you could be convinced that it's the right decision because you're saving a bunch of money and it's meeting some goal of yours, but you're spending without any ability to get any of the money back. $10,000 or more to buy the rate down.
Right.
And it's like that money down the road is extremely meaningful. That money in your pocket is extremely meaningful. It could, this is something we've talked about in videos is our subsidy method. Maybe talk about what that is. And this is just one simple strategy to avoid the buy down and wasting that money.
Right. So say, you're just buying the loan amounts can be $500,000 and another lender is quoting you 3 points to lower that monthly payment. Well, that 3 points is going to cost you $15,000. Instead, we could take that $15,000 and put it aside. And yes, your monthly payment's going to be a little bit higher, maybe by $300 a month.
I mean, let's say 15 grand. Let's say it cuts their rate by 1.5 points. So on a $500K house, maybe it's $200, $250 a month, something like that.
Yeah. So you've got that $15K sitting on the side. You could use that $15K to become your own bank and that subsidize that $250, $300 a month that you would be spending, and that will last you for months on end.
I mean, it's
longer than your break-even point would be.
That's over 4 years.
Yeah, longer than your break. Yeah,
by a mile.
Yeah,
and
exactly.
The beauty is one important thing, just to make sure that you fully understand this concept. You spend that money, you can't ever get that $15K back. Now you're also permanently saving $250, $300 a month. However, if you pocketed that $15,000 and you just paid the extra $250 or $300 a month. You take $250 or $300 a month out of that $15,000 that you keep in your bank account. And let's say that you have a refinance opportunity. We see the earliest possibility of a refi opportunity as rates come down is Q1 of 2023. Perhaps that's about 6 months from now. Maybe that is timeline is somewhere between 6 and 24 months. The beauty is you're only spending it as an option to spend it every month by month. So if you end up refining in 6 months, you've only spent, let's just call it $300 a month. You've only spent $1,800 to effectively out of your own pocket, because you're using the money that you set aside to pay. You've only spent $1,800 of that $15,000, and you have the same result. And then you refi, you save the $300 a month. You don't buy the rate down because rates have come down, and now you are richer by $13,000 in pocket after that. If it takes 24 months, those numbers obviously change, but you still have not saved or still have not spent the full 15 grand. Right. And within the timeline, you're going to refi either way.
Right.
So it's like a waste.
So, and I just did some quick calculations. Say you only take half of that 15K, so 7,500, and invest that into the S&P 500. We all know right now, stocks are on sale because the stocks are suffering as well due to this economy. So say that 7,500 sits in the S&P 500 for 30 years, the life of the loan, then you're walking out with $172,000 cash when it's all said and done. And after that, you never have to put anything into it after that 7,500.
Yeah, so to recap, you invest half that money. The S&P, we're under this scenario, we're saying the S&P turns an average annual profit of 10.5% per year. You keep it in there for 30 years, stock it away for retirement, whatever. This is a little bit more complex than what we were just talking about, but you stock it away for 30 years, that 7,500 turns into $172,000 at, let's call it retirement. Maybe that's your kid's school, whatever it is. I mean, maybe that's down payment for the next house or whatever. I mean, it doesn't really matter, but it turns into significant money. Right. And those are the things that people are missing because they're not paying attention to the big picture. So we say our team, we are holistic mortgage planners. That's what we say we are. It's a self-coined phrase, but holistic means we're looking at everything. We're looking at, okay, granted, the rates are high, the payment is high. How can we utilize the money in the most strategic way possible to help you pocket more and ultimately use those dollars to amplify and maximize your wealth creation long term? So that's one piece. Let's move on from that part. Yep. A big thing, and I can start, unless you have an example of this, so you haven't told me yet, but excessive buy downs, it's an issue. You need better advice because if people are telling you to buy down by an excessive number just to show you the lower rate because they're afraid to talk about the high rate, it's a bad choice. The other thing that we're seeing, which is even a more desperate situation, is bait and switch. Most people know what that means. Have you seen an example of a bait and switch in your business?
Oh, for sure. For sure. I've seen stuff where lenders are not adding in taxes and insurances on their initial quote. And
on the payment.
On the payment, right. Stuff like that. But are you seeing on closing costs too?
For sure. And what we're talking about is a client comes to us. They give us a competitor's bid to compare to make sure they're getting the right deal, which is prudent shopping. Consumers should do that. We're not saying they shouldn't. But they are leaving out very critical details. In TJ's example, they're leaving out critical details like taxes and insurance. Well, on a $500,000 house here in Salt Lake, that is probably $300 to $350 a month. So they're saying, oh yeah, the payment is X, and it meets your goals. What they're missing is another $350 a month that you have to pay to cover the full house expense, taxes and insurance. These are not optional things. It's just the nature of owning a home. I've actually seen that too. I kind of forgot about that. The one that I saw, which just completely blew me away, and it was heart-wrenching for me because I pour into my clients. I take a lot of pride in building a relationship with my clients, being a trusted resource, a valued resource long-term. My whole business has been based on that, creating clients for life. I had a client, we had a great relationship. This actually was a referral from a past client of mine who is a raving fan, has referred all of their family, all of their friends. Anytime they can refer me, they are amazing, which I so appreciate. This client came to me with that trust. It was awesome. I was able to pour into them and help guide them through making the right decisions. At the last second, they somehow got connected with another lender, and it was about, maybe a week or a week and a half before closing. And they're like, hey, we're bailing. We're going to the other lender. And of course, I was heartbroken. And I'm like, wow, why? So I get the details. They send me the bid, and the bid they got was wildly good. Like I could not even believe it. So I went and negotiated, working to match that deal. It was absurdly good, almost unbelievable, but they had the documents to prove it. And so I took it to my corporate office, negotiated on their behalf. I was able to get them some significant discounts on our side because the markets are volatile. So it's just the nature of our business. We have to do that. So I negotiated a better deal for them. And ultimately, like a few days later, I get another set of disclosures from that, my competitor. And the other set of disclosures, he emails and says, hey, that was a mistake. The lender sent the wrong disclosure, and he's referring to the lender because this guy was a broker. I'm not a broker, so we are the lender. We send the disclosures. We don't rely on a third-party lender to send the disclosures. So anyway, he says the lender sent the disclosures inaccurately. Here's the correct ones. The result was more than a $20,000 swing in fees. So his fees looked super low. I mean, like insanely low. It was a big loan amount. But the actual result was $20,000 more than the initial. So
than your initial disclosures?
No. Than his initial disclosure was $20,000 more.
Wow.
Which was ultimately more than my initial disclosure. Now, I still honored the deal that I had negotiated alongside my corporate office. I still honored that for them. So they got an outstanding deal. It was awesome for them. I was able to retain the client. But the bottom line of this is not to brag about us and any of that stuff. It's to say you need to be on guard because there are people making desperate decisions, doing stupid things. This may be because he laid somebody off and there wasn't as much diligence put into the disclosures in the beginning. I don't know what the issue was, but it was a $20,000 swing. They could have gone down the path, and it may have been too late for them to close on time on their new purchase for me to come in and save the day. Had they said, nope, forget it, cancel our loan, we were very close to that. They may have ended up spending thousands and thousands more because of a lack of diligence and, in my mind, a bait and switch. This guy was I don't know. I don't think he's a bad guy. I don't even know him. But I can't, that's just a mistake. Right. It's actually illegal. We can't even do that.
There's so much red tape. Yeah, there's so much red tape.
He
it's
sent
ridiculous.
a legal disclosure, an actual loan estimate, and then changed the actual loan estimate in the lender fees. That is, there's this thing called a zero tolerance, which is our fees cannot change at all up. They can't worsen. They can go down. But they cannot get more expensive after we sent that disclosure. So I don't even know how he did that, but the nice thing was I was able to earn, because of the referral source, and they trusted me in the beginning. I ended up closing that loan, and I was so grateful for it. But it's a story that I've been able to share with clients because there are just people doing stupid stuff, and so you got to be cautious. Well, when it's too good to be true, it probably is. Too good to be true.
It probably is.
It just doesn't make sense.
Well, another example is this popped in my head is advertisements, billboards. Like you can legally advertise discount points with the rate associated that you're posting. So you could have a rate that seems like a really good market rate, but then be charged 3 points in the fine print. Yeah. That rate is just to catch your attention, which is huge too.
Online advertising, they'll structure the deal in a way that's 100% legal. It results in a lower rate and ultimately results in a lower APR. But what they're missing, or what you're missing from the surface level,
is the break-even point.
Yeah, the break-even point. You're paying 2-3 points to get this loan at a lower rate
that you're going to refinance a year from now.
Right. It goes back to how we started this conversation. It's a poor method.
Right.
The way we do business, we don't do any of this billboard advertising, big wide net advertising. We have built a business around trust and reputation that people know that when they're working with us, they are in good hands. We're not going to rip them off. We're not going to screw them over. We're always looking out for their best interest, even if it means that we tell them they should go take another deal. Yeah. I will do that.
Same here.
Probably weekly.
Yeah.
I tell people if there's somebody doing something crazy, it's like, okay, take it. My hope is that in doing so, I've built that reputation. And next time when that deal doesn't exist, because it's only existing now in those circumstances, mostly builder relationships, where the builder's paying a very significant tens of thousands of dollars towards fees, but you have to use their lender. Their lender on before that credit might be more expensive than us, but then with the builder's credit, it's cheaper and we can't match it. It's frustrating for us because it's like, well, builder, you should just give the credit for them using me because they're going to save even more money. It's better for the consumer oftentimes to use us, for example. But that's another conversation. The bottom line is we'll tell people to go take that deal. That is how we run our business. It's just what's in our hearts. We don't.
Well, it creates that. I mean, people are a client for life with us.
We hope. Yeah. Hopefully next time when the builder's not paying those fees, they call us and they get all the right advice, and they knew they got the right advice the first time. And I actually had an agent the other day. One of our past clients, our mutual past clients, called. They were considering a refi. For some reason, I actually told her not to do it. She called another online lender. They're like, "Oh yeah, man, we can do this easy, no problem." She calls me, thank heavens, like, I don't know, a week before closing. I'm like,
stop.
This is I could do the same thing and cheaper. But I told you not to do it for a reason. Let me walk you through this. Here's another strategy. Let's go get a home equity line of credit. Let's bridge the gap. When the rates come down, we'll refi, wrap it all into one, and you're not going to face this. She was first, I kind of was bothered, but she was still hesitant. She thought I was, really? I don't know why.
Trying to take advantage of the situation. Yeah, you're like, I can do it now if I wanted to.
Yeah, it was stupid, but nonetheless, and it worked out to my advantage, but she called my partner, the realtor that referred her to me, because of course the realtors are also very quality sources of neutral advice when it comes to mortgage lending and that type of thing. Well, she called the realtor. The realtor texts me the next day and says, hey, so-and-so called me, and I heard you had a conversation with her. And I just get a glance at the text, and I'm like, oh, crap, did I screw up? Well, thankfully I didn't. I read the message, and she's like, I just want to thank you so much for taking care of our client. That was 100% selfless. You gained nothing from it, and you gave her the right advice.
That's awesome.
And yeah, it was a reinforcement to this. But anyway, this isn't all about us. This is really about you guys, and I think we're just underlining these issues. So the last topic we want to talk about, which is a new thing going around the real estate community, the builder community, and it's something that we're cautioning our partners on, which is very, very important. And it's the end result of seller concessions. So I'll lay the framework. Sellers, well, realtors, builders, sellers, everyone's thinking, hey, let's not drop the price because we don't want to see a decrease in home values at too extreme of a level. So instead, let's just offer concessions. So we'll buy the person's rate down. And some of these concessions are massive, 20, 30, 40,000 bucks. It's crazy. Let's buy the rate down again. Depending on the circumstance, we generally don't buy into that whole idea of buying the rate down because they're impermanent savings. If you refi, all those savings are gone, and you could have permanently saved that by dropping the price of the house, for example. Now, it's a dance we have to play because all of us want high values.
Right.
But
and it can also help with qualifications too, the rate. 100%. So make sure you're talking with us beforehand, but continue.
Yeah. No, yeah. There are strategies to it, but the bottom line here is a word of caution, mostly for the people in the industry, perhaps other people that are not in the industry that are thinking about selling a home. Something to be aware of, and I've seen it a couple of times in my 15-year career, when seller concessions become very prevalent in the marketplace. So instead of dropping the price, they're trying to keep values high, and instead they're offering big concessions. What appraisers can, and I mean most likely, unless this solves itself sooner than later, will start doing, is they will take, for example, sales price is $500,000. Seller giving $25,000 in seller concessions to buy the buyer's rate down or pay for their fees, whatever. They'll actually say $500,000. They'll deduct from the value the amount of concessions, and this is in the comps. So this isn't on the actual subject property, but in the comps, say it sold for $500,000, seller paid $25,000. They'll say $500,000, an immediate deduction of $25,000 for concessions, or maybe an immediate deduction of $20,000 because $5,000 is just a market-driven concession, but the extra $20,000 is excessive. So now that comp for appraisals, the sale price to compare against the home that you may be buying, your client's buying or selling, that comp is no longer a $500,000 sales price. It's now effectively a $480,000 or a $475,000 sales price. So we may not actually be solving the problem temporarily for now. We haven't seen that take hold yet in this market, but we need to be cautious of that because it can affect appraised values.
That is huge.
What do you have? Anything else?
No, I'm good over here.
Cool. Awesome. Well, guys, thank you so much for listening. I hope this was helpful. If you don't mind, I know we've said this before. We say it in every video. Please share this to anyone you know that you think it might bring value in. We're looking to grow our exposure so that more people hear the strategies, the ideas, the concepts, the details that we're talking about in the industry, because we really care about helping you guys understand what's going on, making better decisions, and hopefully optimizing your mortgage experience and maximizing the wealth creation through that. But thanks for tuning in, and we'll catch you next time.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.